The inflation level is historic and most likely it will not get any better anytime soon. But inflation is not only a bad thing, it can have some positive characteristics as well. It is important to understand in depth this economic phenomenon so you can potentially prosper in the coming hard times. Hello guys and welcome to the Market Watcher, a place for gathering traditional financial and crypto knowledge on a regular basis. Subscribe to the channel, hit the bell icon and like the video if you want to increase your economic, investment and financial understandings. Inflation is the rise in prices, which can be translated as the decline of the purchasing power over time. The rate at which purchasing power drops can be reflected in the average price increase of a basket of selected goods and services over some period of time. The rise in prices, which is often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Inflation can be contrasted with deflation, which occurs when price declines happen and the purchasing power increases. While it is easy to measure the price changes of individual products over time, human needs extend beyond just one or two products. Individuals need a big and diversified set of products, as well as a host of services for living a comfortable life. They include commodities like food grains, metals, fuel, utilities like electricity and transportation, and services like healthcare, entertainment, and labor. Inflation aims to measure the overall impact of price changes for a diversified set of products and services. It allows for a single value representation of the increase in the price level of goods and services in an economy over a period of time. Here on the chart you can see the change in the consumer price index for all urban consumers over the previous 12 months ending in July of 2022 in the United States. The level sits at 8.5% currently. The index remained unchanged on a seasonally adjusted basis after seeing a 1.3% increase in June. On the next chart, you can see the consumer price index in the European Union, where the inflation rate sits at 9.6% for July. Almost all developed and emerging economies follow the Keynesian economic principles, which say that an inflation rate between 2 and 3% is ideal. When the inflation rate goes above a 3% level, it is considered to be high. The more above this level the rate is, the more it is considered to be out of control. Although inflation from first glance seems to be only a bad thing, it has both cons and pros. Inflation can be construed as either a good or a bad thing depending upon which side one takes and how rapidly the changes occur. Let's discuss both parts. Let's first start with the pros. Individuals with tangible assets like property or stocks, commodities, and others priced in their home currencies may like to see some inflation, as that raises the prices of their assets, which then they can sell at a higher price. Inflation often leads to speculation by businesses in risky projects and by individuals who invest in company stocks because they expect better returns than inflation. An optimum level of inflation is often promoted to encourage spending to a certain extent instead of saving. The Keynesian theory refers to a probable and good inflation of between 2 and 3%. If the purchasing power of our money falls over time, then there may be a greater incentive to spend now instead of saving and spending later. It may increase spending, which may boost the economic activity in a certain country. A balanced approach is, though, to keep the inflation value in an optimum and desirable range between lower digit numbers, 2 to 3%. Let's now discuss the cons. Buyers of such assets may not be happy with inflation as they will require to shell out more money. People who hold assets valued in their home currency, such as cash or bonds, may not like inflation as it erodes the real value of their holdings. As such, investors looking to protect their portfolios from inflation consider inflation-hedged assets such as gold, other commodities, and real estate investment trusts, or REITs for short. Inflation-indexed bonds are another popular option for investors to profit from inflation. High and variable rates of inflation can impose major costs on an economy. Businesses, workers, and consumers alike must all account for the effects of generally rising prices in their buying, selling, and planning decisions. This introduces an additional source of uncertainty into the economy because they may guess wrong about the rate of the future inflation. Time and resources expended on researching, estimating, and adjusting economic behavior are expected to rise to the general level of prices. That's opposed to real economic fundamentals, which inevitably represent a cost to the economy as a whole. Even a low, stable, and easily predictable rate of inflation, which some consider otherwise optimal, may lead to serious problems in the economy. That's because of how, where, and when the money enters the economy. Whenever new money and credit enters the economy, it is always into the hands of specific individuals or business firms. The process of price level adjustment to the new money supply proceeds as they then spend the new money and it circulates from hand to hand and account to account through the economy. Inflation does drive up some prices first and drives up other prices later. The sequential change in purchasing power and prices, known as the Cantillion Effect, means that the process of inflation not only increases the general price level over time, but it also distorts relative prices, wages, and rates of return along the way. Economists in general understand that distortions of relative prices away from their economic equilibrium are not good for the economy, and Austrian economics even believe this process to be a major driver of cycles of recessions and booms in an economy. The way that the inflation level is controlled in the most effective way is by lifting up the so-called main central bank interest rate. When this rate is lifted higher, all debt costs go higher as well. This in turn makes individuals and corporations to stop taking out debt and makes them repay their current debts, which in turn brings down the money supply and helps slow the inflation level. Often this process brings recessions with it due to the fact that it slows the growth rate, and as the great investor and economist Ray Dalio says, credit is what drives the growth of an economy. Less debt means less growth means a usual downturn for the economy. This was our video about the inflation phenomenon. Don't forget to subscribe to the channel, like the video, and hit the bell icon so you won't miss out any of our newly upcoming interesting content. Thanks for watching until the end, and I'll see you in the next video.